what was your strategy when you guys decided to go out for capital? What were your goals and what ended up happening?
It's funny. I wrote a post the other day which got a lot of love. I think it had almost 1,000 likes and hundreds of thousands of views on it, which said this is the absolute best way to raise money. And I literally talk about our journey bootstrapping while building a community. So we weren't thinking of raising, seriously. My co-founder, Alex, he has been very anti-raise given past background and what we've seen, right? You give up a lot of control and you do somebody else's zero-sum game. You feed into somebody else's definition of success, and he was against that. Now, Alex is based in Vancouver, Canada. I'm based in San Francisco. My view is very different, but nonetheless, I've only worked at failed startups or been a part of failed startups. And my wife's a physician, and when I talk to her about raising, she's like, if you're going to raise money now that the company is bootstrapped and doing well, and you build somebody else's zero-sum game, and you fail, I cannot keep supporting the family. You're going to have to get a job at like Salesforce or Oracle or Google, and like, this is it. This is like 10 plus years of only either working as an exec at startups or like being on founding teams, and like nothing's ever worked out. And like the thing is, you don't even get a proper salary. That's even worse. So I got to pay the bills. So that fear was there, right? And then what had happened was we hosted an event when there was a window of opening during the pandemic. So we were to do the big conference, Traction conference in 2020, and the pandemic hit, obviously, and we had to cancel. Now, I can't sit through hours and hours of content, so I didn't have the heart to produce a 2-day virtual summit. So I reached out to all the speakers, and I'm like, listen, would you be willing to hop on a 1-hour AMA with our audience? So these were like these podcast recordings, but live with an audience. And so we started doing them weekly. Gave us like 2 live webinars a week, which we turned the video into YouTube, the audio into podcast. And it started doing well. We like on average, we get like 8,000 to 10,000 views on YouTube. But anyway, it started doing well. And then there was a window. Our audience started growing, and we used that window of opening to host an event. Now, one of the investors from our VC, one of the partners, came to this event. And they reached out wanted to know who runs this event, because they were very impressed with the quality of founders and everything there. And so I got on the phone, and they're like, hey, would you be willing to join our venture partner network, and we'll give you carry and this and that. And I'm like, guys, I don't have the time for this. I'm just like doing these events because it funnels like leads to the business and drives our brand. But I really don't have the time to be a scout for a venture capital fund. And they're like, oh, what does your business do? So I explained, and they're like, what? You're selling $100 bills for $20? You're literally saying, we'll give me your data, we'll give you money from the government, and when you get the money, we'll take a percentage. And they're like, oh, what are your gross margins? And what is the growth rate? And how are you funded? How's the cap table? They're like, we'd love to invest in the company. And I'm like, listen, we don't want investor money. We're good. And they're like, we're not traditional investors. I'm like, then what are you? Like debt lenders? And they're like, listen, we're growth equity. I'm like, what is that? And they explained so there's the VC, which is invest and put everything in growth, and you're either boom or you're bust. There's boom or bust, but there's also an in-between, which is happening right now, right? A lot of founders with small growths or like just they experienced huge growth only because of the pandemic, artificial digital transformation time zone, but they couldn't sustain that growth, and now they're zombies. So like VCs who fund companies that end up being like slow growth or bust, they either force them to shut down or they don't give them attention. So there's that VC, which is like, I want to see you like triple, double. And there is the PE or an exit, which is a buyer company, right? They're like, we're in between. If you're like 5 million plus in revenue at 80% gross margin, seeing decent growth and clean capital, profitable, we'll invest in the company, but it's more like we'll invest from 30% to 70% of the company, and we'll liquidate the founders. So you de-risk yourself, you can take money off the table, and you can also play the long game by being involved in the company. And that like perked up my ears. I'm like, what? Seriously? I'm like, my jaws are up. I'm like, are you kidding me? Like, this is an asset class. This is what people do. They're like, yeah. So then I started back channeling it. I brought it up to Alex. I had another meeting with the guys because it was open. And one of the partners was in San Francisco. The guys are Radiant Capital out of New York, really good guys. One of the partners happened to be in San Francisco, so I met with him, seemed really good, back channeled a few conversations. Alex also looked them up and they're like, hey, it's good. So that was honestly the decision was you're in the middle of a pandemic. You can feel it, although the VC world didn't want you to feel it, that this growth that is happening, that this boom is a function of everyone needing to transact online, and it's not going to last forever. And that's exactly what happened, right? All the VCs knew it was a gamble. If you can't transact in person, you need to go online. If you go online, you need Zoom, Shopify, Snowflake, Twilio, maybe a whole bunch of different tools, right? And that's the reality of the situation. And so everybody needed to transact online. And the growth you experienced in 2020 and 2021, you can't sustain, obviously. And so at the turn of 2022, interest rates went up because they couldn't keep the interest rates low forever. And a market falling always follows an interest rate hike. A recession always follows an interest rate hike. You can look at every recession. And this was a 1-2 punch because the companies couldn't sustain the growth they had in 2020 and 2021. So started missing projections in 2022, coupled with, hey, interest rates are up. So now what happened? Valuations, markdowns, customers are not buying, missing projections, not growing, a lot of zombie companies. The unicorn porn that was proliferated in 2020, 21 is like shattered, right? And so I think it was a good bet that we played for us personally, and also good for the company because you're on a path to grow sustainably, right? And if you look at it, especially in SaaS, especially when you have recurring customers, recurring revenue, even if you're going slow, after 10 million, you're going to have to shoot somebody in the face to take it to zero, right? And so why try to build some zero-sum game and try to aim for go from 10 to 30 million in 1 year and hire more people? Like more die of indigestion than starvation. Why try to choke the system and ruin something good? And so I think we made the right decision, because had we raised a lot of money and put it just on the balance sheet and tried to gone from 10 to 30, I don't know if it would have played out like that. I think we would have destroyed the company, and it would have been a gamble, basically, right? Yes, we had a repeatable, scalable channel. It was community that we built that had been growing, coupled with sales team. And our sales team had great social proof because there was a lot of going to events, going to our events, hosting our events, partnered events, and, shaking hands, kissing babies, like a lot of that. And so when you cold email or call, there's social proof there associated. But now if you it's never linear like that, right? Oh, you got 10 salespeople, let's add 50 and, 5x the revenue. It never works like that, right? Because you got to add SDRs, you got to add SDR managers, you got to add operations, there's a lot of in-between stuff that goes on, like piping and tooling and process, and it breaks. I mean, I've seen this with a lot of friends. So I think we made the right decision for sustainable growth and de-risk the founders who had been burning their soul for the last several years.